Carolina Sanchez-Paramo and Amber Narayan are both senior economists in the Poverty Reduction and Equity Unit in the anchor of the bank. Caro, please.
Okay, so now that you know who we are, thanks, Jaime, for the introduction, and thank you, everybody, for coming this morning. I won't repeat some of the things that Jaime said, but I do want to say that this is work that we did in the Poverty Reduction and Equity Unit together with country teams all over the bank. And the idea was that this would be joint work, and it would basically try to touch upon as many regions as possible in order to explore the extent to which there were common patterns in terms of the impact of the crisis across those regions. So that's what we will try to highlight in this presentation. Of course, as you can imagine, there were also many, many differences in terms of the impacts of the crisis across these countries, and we get into the details of those in the context of the country notes that we've prepared for each country. So I don't want you to walk away from here thinking that what we're trying to say is that this was the same all across the countries, but rather we are trying to point out that some of the things were actually kind of common, and maybe some lessons can be learned from that experience. Having said that, let me give you a little bit of an overview about how we'll structure this. I'll try to motivate why we actually undertook this exercise a few months ago, although I'm sure by now this is relatively sort of known to everybody. Then I'll give a short overview of the model, and I'm happy to get into more details in the questions and answers. I'm just not going to dwell on this very much because I think it would be more interesting to sort of get to the results. And then we'll go through the results in more detail, and somewhere along the results, I'll switch over to Amber so that for those of you who are falling asleep, you can sort of wake up when that happens. So when we started this work about a year ago, the main rationale for this was that, as Jaime said, the financial crisis, was sort of moving from developed economies to developing economies through a variety of channels. I think there was already an understanding of the fact that this was a rather complex crisis in terms of these channels being, varied and their importance sort of varying across countries, depending on their economic structure and so on. And also I think there was a clear understanding that there were some short-term impacts and there would be also some long-term impact associated with that. And as Jaime said, unfortunately, we didn't have a lot of information on the actual impacts. So we had some hypotheses about what could be happening in terms of poverty and distribution, but there wasn't really a lot of real data to back those up or to at least test them. As Jaime also said, there were some efforts that were sort of kicked off early on, and Carrie is here. She did a lot of qualitative work trying to understand what was happening in various countries. ECA also launched a bunch of rapid response surveys, but in most cases that information wasn't there. So there was a demand from the regional teams to try to use existing tools to at least inform the discussion with governments in terms of what could be happening and what could be done about it. So that's kind of where this work came from, and that's why working with the country teams was extremely important in terms of reflecting the context and what was exactly happening in the countries that we were looking at. Precisely because of what I said, I think in the early discussions with the teams, what was clear is that the methodology to be chosen needed to be able to capture multiple transmission mechanisms and also capture impacts all across the distribution, not just aggregate impacts on poverty and inequality. And that's what provided the motivation to use microsimulation models. We didn't invent the wheel. We basically worked on existing models and sort of tweaked those around to fit the country context, and in some cases to simplify some of the methodological requirements, primarily driven by data availability. The focus of the work that we've done, it's on labor markets and remittances, primarily international remittances, because from the discussions with the team, these seem to be the two most important channels of transmission, so we focused on those, even though we do pay some attention in the simulation to other sources of income, but you'll see that most of the results basically will talk about either labor markets or international remittances. What's interesting about microsimulation exercises in general is that basically what you get at the end of the exercise is really a new household data set, and you can basically work with that the same way you would work with any household data set. So you can calculate aggregate poverty, aggregate inequality, you can look at distribution, and so on. So that's what we will be doing. And as Jaime said, I'll be presenting results from 4 countries, and we have 2 other countries that are ongoing and we are on the process of completing. And the idea here, why some of you may be wondering, well, why these countries and not others? Basically, this is where we were fully responsive to the regions, and these were the countries that we were actually asked to look into. Mexico was deeply affected. Some of the other countries were affected, but not so much. So it gives you kind of a mix in terms of what could have happened. But we're hoping that it's representative to some extent of what was happening in different regions. And I'll get a little bit more into what the shocks looked like in each of these countries later on. So what is a microsimulation exercise? What is it that we do? We really have sort of 2 types of countries. We have countries where, as a consequence of the crisis, GDP growth slowed down significantly, but it was still positive. So for those countries, really the comparison that conceptually makes the most sense is basically to ask the question, okay, what's the difference between what we see, so slower but still positive GDP growth, and a hypothetical situation where there was no crisis. So say if we could look at the year 2009 or 2010 with no crisis and with the crisis, and we compare those 2, what would those differences be? So that's sort of this comparison between treatment and crisis. And we do that for every country where we still observe positive growth. And those basically are those are Bangladesh, Philippines, and Poland in this presentation. In the case of Mexico, GDP actually went negative. So they experienced about -6% GDP growth in 2009, and they'll start recovering a little bit in 2010. So in that case, both the country team and the Mexican authorities expressed that they really didn't want us to construct any hypothetical. What they wanted to know was what was happening now, and when we compare that with 2008, what the differences were. So in the case of Mexico, the comparison we're going to show you is a time comparison, as opposed to a contemporaneous comparison between a hypothetical and a crisis scenario. So I think Ambar will sort of try to repeat this as we go, but just keep it in the back of your mind, because when you see the cross-country comparisons, I do want you to remember that those comparisons are slightly different depending on what country we're talking about. What are the data requirements for some of these exercises? And I think some of what I'm going to say here probably applies to all 3 exercises that will be covered today. Of course, you need some macro information on what is projected to happen. And we basically, we work with the country teams to get this information. So this is information that we are receiving either from the countries themselves or from the country teams. We didn't do any work on the macro aspect of things. So this is information on GDP, international remittances, prices, and so on. And then, because we need to translate this information into labor market developments, primarily changes in employment and changes in earnings, we need to estimate some parameters for us to be able to do that. And the key parameters in the exercise are basically the output elasticity of employment, both at the aggregate level and by sector, and the output elasticity of labor force participation. And in most cases, we've gone about this using historical data, and there's been quite a bit of effort that has gone into checking for robustness when you change these parameters, because they are fairly sensitive to the information that you're using. We also try to control for population growth. This is particularly important in those cases when the last available household survey dates from many years ago, like, for example, was the case on Bangladesh, and when you actually have pretty rapid population growth. Because in a way, you do want to take into account for the fact that the working age population has grown significantly in the years preceding the crisis, and that may have had an impact itself on what happened during the crisis. And finally, we use microeconomic data coming primarily from household surveys. And the main requirement there was for these surveys to have relatively good information on labor variables such as labor status, labor income, and so on. And of course, the poverty lines. And here we basically work with the poverty lines, with the national poverty lines. So we didn't use any sort of standardized poverty lines for the analysis. So let me give you an overview for what the exercise looks like without getting into enormous amounts of detail. And as I said, we'll be happy to come back to any questions on methodology that you may have at the end. And And again, I think some of this is relevant for some of the other presentations because in a way, sort of the philosophy, quote unquote, of these exercises is quite similar. So the overall objective is to basically, in the end, predict what income and consumption would look like under different scenarios at the individual and the household level. So how to go about that? There are basically 3 stages to the exercise. The first stage, which we call calibration, basically works primarily with the microdata. And the main objective of this stage is to extract information from the microdata in such a way that you're fitting what you see in the microdata best. So the idea is the models that we estimate here will basically choose models that give you the best fit. What models are we estimating? Well, we are basically taking the pre-crisis data and estimating 2 models. One model that will predict for each individual of working age in the survey, what's the situation that they are most likely to be in with respect to the labor market. What this means is that we'll estimate for each individual what's the likelihood that they are in or out of the labor force. If they are in the labor force, what's the likelihood that they are employed in agriculture or manufacturing or services, or that they are unemployed. And basically, as I said, we'll estimate this on the pre-crisis data, and then we'll use those parameters later on, as you'll see, to predict what will happen for different individuals. For those individuals that are employed in the pre-crisis situation, we'll also estimate an earnings equation using their observable characteristics. And again, we'll use those parameters later on. And finally, because we want to focus on remittances, we also need to come up with a way in which we are going to assign either increases or declines in international remittances in this simulation exercise. When we started to work on this, what we thought was that we would be able to actually also construct a model for this in the form of a probability model or something similar. What turned out to happen was that the information in the micro surveys was actually very poor for us to do that. So we tried, and eventually we got something that was more noisy than just doing it randomly. I mean, it literally made no sense. So this is a very unstructured part of the simulation, and we can get into a little bit more detail. But basically what we ended up doing was using information from the survey in terms of the geographic distribution of existing remittances, because you actually do see significant patterns in terms of where the migrants come from and where the remittances go to. So we actually exploited that, but at the household level, there was very little that we could actually turn to in terms of information on either migrants or migration decisions or anything of that sort. So once we have those parameters from the models, we move on to the next stage, which is kind of the simulation proper, so to say. So here is where the macro projections come into play. And if you want, the rule here is that we want to replicate at the micro level the changes that we observe at the macro level. And I do want to sort of emphasize this because basically we are not trying to replicate levels in any way. We are trying to replicate changes. So the idea is that, we have observed changes in GDP. We construct from those observed changes in employment, both at the aggregate level and at the sectoral level. And then we use the parameters from the models that I just described to basically simulate those employment changes at the micro level by basically moving individuals in and out of the labor force, in and out of employment, or across sectors, depending on what the macro projections are telling us to do. And again, I'm happy to get into more detail as to how this happens, but it's basically using information from the structural models that we estimated using the pre-crisis data. What do we use the earnings equation for? Once we've moved individuals around, basically we will have individuals who are either changing sectors or who are actually becoming employed, sometimes for the first time. For those individuals, we do not have information about their wages from the pre-crisis data. So we will need to estimate some earnings for them. And that's where the earnings equation comes in. That's what we use it for, to predict earnings for those individuals that do not remain where they were in the pre-crisis situation. It is also at this stage when we introduce population growth to account for primarily growth in the working age population. I mean, that's really the main reason. And what comes out of here, once we run the simulation exercise is basically, as I said, one or more, household survey data sets with projected employment status and projected income. Okay. So then we go from there to the final assessment. The last adjustment we make before we actually calculate poverty and inequality and other measures is to adjust for price data. The whole exercise is run in real terms. So what is